Hello everyone, how's it going? In this video, we will talk about GTII, its trading potentials, if the stock deserves to have a place in your portfolio, and why there could be a massive gain that's possible from not just the ongoing short squeeze, but the company itself. Before I begin today's topic, if you appreciate my content and would like to support my channel, please give my videos a like, comment, and subscribe to my channel. Also, please consider to take a look at the affiliate links down in the description. For the Amazon link, you can simply save it as your bookmark so that every time you purchase anything from it, a commission can be paid to me without additional costs for you. Thanks for your support, it means a lot to me. And with all that being said, let's start today's video. Over the past few days, GTII has been trading around $1.65 and saw its price going up by quite a margin, essentially wiping out the previous fears that it may break its current recovery trend. Now, I wouldn't say that it's necessarily a surprise, but it's also only one of the potential scenarios to see that GTII to recover back from where it was, to stay above $1. That's what I'm trying to say. So over the course of the past month, the stock has been down by almost 20%, meaning it went back by about 10%, which is significant, essentially causing a shift in people's attention and the interest towards the company. And this is very important because it's mostly a stock that depends on people's interest, like retail interest, in order to keep the ship afloat. As long as people think that there's some quick money to be made, then yeah, they're gonna buy it. This is the kind of company that GTII is. On the other hand, it also kept its bullish tendency alive despite all the difficulties, despite a hostile environment since the beginning of this year, and it's currently sitting close to the $1 level or remains above it, which is very positive. Now, in the anticipation that the stock eventually recovers or even takes off due to like short squeeze, I would say that we are reasonably positive that something of that sort will happen, simply because at some point these reactions would not be based on emotions, they will just based on math. Global Tech Industries Group, trading under the ticker symbol GTII on the OTC market, is a company based in Nevada focused on acquiring growth and startup companies to build its portfolio of promising companies for tomorrow. So simply put, it is an acquirer whose value depends largely on the expertise, assets, research, and people that they buy within the sectors of technology and growth companies. The reason why this kind of structure can be attractive is because the narrative is not only interesting, fresh, but also flexible and can adapt to whatever that is currently trending in the market. Of course, this may not be what you want to hear if consistency and continuity are no negotiable value in your portfolio. But for market participants who simply want to make a quick buck, by buying low and sell high, this is actually a very interesting position to have. In a way, GTII reminds me of companies that we have covered before on this channel, such as Ideanomics, trading under the ticker symbol IDEX. It may not have the same kind of purchasing profile, shall we say, but ultimately the value and the proposal of value relies on the company's capacity to retain valuable assets with high potentials to be popular and trending topics in the months and years to come. It's like putting your money in a publicly traded VC fund, so to speak, or early-stage business incubators. Because the investment can be done at a very early stage, the equity may be very inexpensive to acquire to be later sold during a different economic phase. That is essentially the reason why companies like GTII have always interested the market. It's not always because we believe wholeheartedly in the projects or the companies they have acquired over time. With that being said, those kinds of companies obviously come with their own risks, like the lack of trust in the market, or even more simply, the lack of demand for risks at the moment. If the market remains bearish overall for many reasons, of course, with many titles losing value, it's going to be a matter of time before capital becomes more risk-averse than ever and would collectively prefer to head back to the bonds, to the guaranteed deposit certificates, and blue chips to tough through the financial winter, which might be particularly cruel and long this time. This kind of situation is not only bad from a fundamental point of view, but also from a financial perspective. It may force the company to get funds either at higher interest rates or from companies that will actively try to make money at their expense. This is precisely what happened with GTII. Some time ago, it entered into an agreement to obtain funds from an entity with a tracked history of shorting companies they know are having a rough patch. This is the kind of short-selling behavior that can be seen in times of crisis as well as in periods of bubbles. What happened between 2020 and 2022 ticked both boxes, and GTII is therefore very vulnerable for this kind of behavior. A stock can be borrowed from brokers, sold in the market, and be bought back later, preferably at a lower price than when it was first sold. Unlike the typical long positions, a short position will generate financial fees that need to be paid periodically to keep the position open, which would further motivate the short sellers to buy back their positions if they can spot a movement against the shorts, regardless of whether it can be justified or not. Sometimes it's just because a bunch of people decided to buy in. This is another major attraction of GTII. It has an important short position stacked against it, which is another way to say that there is a high potential for short squeeze to occur, which may force many short positions to be redeemed so that the short sellers don't suffer massive losses. Now, we have to remember that if we have long positions, the potential loss is between the entry price and zero. The potential loss for short positions, on the other hand, is much higher because it would be between the entry price and infinite high, in addition to the financial costs payable on a periodic basis. With that being said, GTII obviously offers a lot of potentials and opportunities in the upward volatilities. But remember, we must remain vigilant about the market mood, both in its own right and towards GTII in particular. We should also consider whether the company is really a decent company to invest in for the long term. Let's not forget that Ideanomics is now a penny stock, having long passed its prime. This is the scenario that we definitely want to avoid. We don't want to stay too long. So, my opinion towards GTII remains that it is a company best suited for short-term trading and not long-term holding. So, based on my analysis, I would definitely recommend to buy GTII at the current price and to keep the stock on your short list for at least short-term trading, and maybe at some point start to buy in for long-term holding. Because as long as your position is kept at very small size, I don't think that it's going to hurt that much, even if the stock tanks, right? So I would say that the maximum exposure for trading should be between 1 to 3% of your portfolio. And if you want to invest in GTII, the exposure should remain below 1%. And I would highly recommend you to cash out the position once it reaches at least 40 to 50% of profit margin.